Blowing a trading account doesn't happen by accident. It happens step by step, trade by trade, decision by decision. And most of the time, traders don't even realize they're heading toward it until it's too late. They think one big loss caused it, one bad trade, one unlucky moment, but the truth is much harder to accept. Accounts don't get destroyed by one mistake. They get destroyed by a pattern of poor decisions, emotional reactions, and a complete lack of risk control. Today, we're going to break down exactly how traders blow their accounts, and more importantly, how to avoid it. Because surviving in trading isn't about making the most money, it's about not losing everything. The illusion of "it won't happen to me." Every new trader starts with confidence. They see other people losing money and think, "that won't be me. I'll be more careful. I'll learn faster." And at the beginning, they often are careful. They risk small amounts. They follow basic rules. They try to stay disciplined. But then something changes. They get a few wins. Maybe they double a small account. Maybe they catch a strong move in the market. And suddenly, confidence turns into overconfidence. They start believing they've figured it out. And that's when the danger begins. Because blowing an account doesn't start with fear. It starts with confidence. The first crack: increasing risk. One of the first steps toward blowing an account is increasing risk too quickly. A trader starts with small position sizes, but after a few wins, they begin thinking, "if I can make this much with small risk, imagine what I can make with bigger risk." So they increase their position size, maybe from 1% per trade to 5%, then 10%, and sometimes even more. At first, this can work. If the next trade wins, the account grows quickly, and that reinforces the behavior. It feels like progress. But what the trader doesn't realize is this: they've just increased their vulnerability. Now, one losing trade doesn't just hurt, it damages the account significantly. And if 2 or 3 losses happen in a row, the account starts dropping fast. Professionals avoid this completely. They don't increase risk based on emotion. They increase it slowly, carefully, and often not at all. Because they understand big risk leads to big drawdowns, and big drawdowns are hard to recover from. The dangerous thought: "I'll win it back." After a loss, a thought appears, a very dangerous thought: "I'll win it back." This is where many accounts begin their final decline. Because this mindset shifts the goal. The trader is no longer following a strategy, they're trying to recover money, and that changes everything. They start taking trades they normally wouldn't take. They enter earlier, they exit later, they ignore their rules, and most importantly, they start trading emotionally. If the next trade loses, the pressure increases. Now they want to recover even more, so they take another trade, and another, and another. This is how small losses turn into large ones, and large losses turn into account destruction. Overtrading: death by 1,000 cuts. Another common path to blowing an account is overtrading. It doesn't always look dramatic. It's not one big loss, it's many small ones. A trader sits in front of the charts for hours, watching every movement, looking for opportunities. Eventually, they start seeing setups everywhere. Every small move looks tradable. Every candle feels like a signal. So they start entering trade after trade. Some win, some lose. But over time, the losses begin to add up. Fees increase, mistakes increase, fatigue sets in, and the quality of decisions drops. Overtrading is dangerous because it feels productive. It feels like effort, but in reality, it's just increasing exposure to risk. Professionals don't trade more. They trade less, but with higher quality. Ignoring the stop loss. One of the fastest ways to blow an account is ignoring the stop loss. At first, most traders use stop losses.
They understand the importance, but then a trade goes against them, and instead of accepting the loss, they hesitate. They think the market might come back, so they move the stop loss further away, or worse, they remove it completely. Now the loss is no longer controlled. It starts growing. The trader watches the chart hoping for a reversal, but hope is not a strategy, and markets don't move based on hope. What started as a small, manageable loss becomes a large, painful one, and this single decision can undo days or weeks of progress. Professionals never allow this to happen. For them, the stop loss is not optional. It's a rule, a non-negotiable rule. The role of emotions. At the center of every blown account is emotion, fear, greed, frustration, impatience. These emotions influence decisions in subtle ways. Fear causes hesitation. Greed causes overexposure. Frustration leads to revenge trading. Impatience leads to poor setups. And over time, these small emotional decisions stack up until the account can no longer handle the damage. The market doesn't destroy accounts. Emotional decisions do. The false focus on strategy. Many traders believe their problem is strategy. They think, if I just find a better system, I'll stop losing. So they jump from one strategy to another, indicator to indicator, setup to setup. But the problem isn't the strategy, it's how they manage risk. Even the best strategy will fail if risk is not controlled, because no strategy wins all the time. Losses are part of the game, and without proper risk management, those losses become destructive. Professionals don't obsess over finding the perfect strategy. They focus on protecting themselves when the strategy fails, because it will fail, and that's normal. The snowball effect. Blowing an account rarely happens instantly. It builds, like a snowball rolling downhill. It starts small, a slightly bigger risk here, an emotional trade there, a missed stop loss, a few extra trades. Each decision seems minor on its own, but together they create momentum. And once that momentum builds, it becomes harder to stop. Losses increase, emotions intensify, decisions become worse, and eventually, the account reaches a point where recovery is nearly impossible. The reality check. Here's the reality most traders avoid. Blowing an account is not bad luck. It's not the market being unfair. It's not manipulation. It's the result of poor risk control. And the good news is, that means it's preventable. If you can control your risk, you can avoid blowing your account, no matter what strategy you use, no matter what market you trade. Because in the end, survival is a choice.
The rule that changes everything: risk per trade. If there is one rule that can dramatically reduce your chances of blowing an account, it's this: never risk too much on a single trade. Professional traders usually risk a small, fixed percentage of their account, often around 1%, sometimes even less. This might sound small, it might even feel slow, but this single rule creates a powerful safety net, because no matter what happens, no single trade can cause serious damage. Let's think about this clearly. If you risk 1% per trade, you would need to lose 50 trades in a row to lose half your account. That's extremely unlikely. But if you risk 10% per trade, just 5 losses in a row can destroy nearly half your account, and that kind of losing streak is very possible. This is why risk per trade matters so much. It's not about how much you can make, it's about how much you can survive. Building a safety system. Professional traders don't rely on discipline alone. They build systems that protect them because they understand something important. In emotional moments, discipline becomes unreliable. So instead of trusting themselves to always make the right decision, they create rules that make bad decisions harder. These rules form a safety system, a structure that protects their account even when emotions are high.
For example, they predefine their risk before entering a trade. They set stop losses immediately. They calculate position size carefully. They avoid trading without a clear setup. These actions happen automatically. They don't depend on how the trader feels in the moment. This system-based approach removes a lot of emotional pressure because the decisions are already made in advance. The power of the daily loss limit. One of the most effective tools professionals use is a daily loss limit. This is a simple rule. If you lose a certain amount in a day, you stop trading. No exceptions. For example, a trader might decide, if I lose 3% of my account today, I'm done. This rule might seem restrictive, but it's incredibly powerful because most account blowups don't happen in one trade. They happen in one bad day. A day where everything goes wrong. A day where emotions take over. A day where the trader keeps trying to recover losses. The daily loss limit stops that spiral. It forces you to step away, to reset, to come back with a clear mind the next day. Professionals don't try to win every day. They focus on protecting themselves on bad days. Why doing nothing is a strategy. One of the hardest lessons in trading is learning to do nothing. Most people believe they need to be active to succeed. They think more trades mean more opportunities, but in reality, more trades often mean more mistakes. Professionals understand that not trading is a valid decision. If the market conditions are unclear, they stay out. If they don't see a high-quality setup, they wait. If they're not in the right mental state, they stop. This patience protects their account because every trade carries risk, and unnecessary trades carry unnecessary risk. Doing nothing might feel unproductive, but in trading, it's often the smartest move you can make. The importance of trade quality. Not all trades are equal. Some setups have higher probability, better structure, clearer risk. Others are weak, unclear, based on emotion rather than logic. Beginners often treat all trades the same. They enter frequently, without much filtering. But professionals are selective. They wait for high-quality setups, even if it means taking fewer trades, because they understand that quality matters more than quantity. One good trade is better than 5 random ones, and over time, this selectivity reduces risk significantly. Controlling the urge to recover losses. After a loss, there's a natural urge to recover it quickly. This urge is one of the biggest dangers in trading because it leads to emotional decisions. The trader starts thinking short-term. They stop following their plan. They focus only on getting back to where they were. But this mindset is destructive because trading is not about recovering losses immediately. It's about staying consistent over time. Professionals don't chase losses. They accept them. They understand that losses are part of the process, and they trust that if they continue following their system, the results will balance out. This patience protects them from making impulsive decisions. The role of consistency. Consistency is what keeps an account alive. Without consistency, risk becomes unpredictable, results become random, and control is lost. Professionals aim for consistent behavior, not perfect outcomes. They follow the same rules every day. They risk the same percentage. They take trades based on the same criteria. This consistency creates stability, and stability prevents chaos. Because most blown accounts are not the result of bad strategies. They're the result of inconsistent behavior. One day the trader is disciplined, the next day they're emotional. One trade follows the rules, the next trade ignores them. This inconsistency creates unpredictable risk, and unpredictable risk is dangerous. The mental shift from winning to surviving. One of the biggest mindset shifts a trader can make is this: stop focusing on winning, start focusing on surviving. Winning is exciting, it feels good, it creates confidence, but survival is what keeps you in the game. Because trading is not a sprint, it's a long-term process. And if you can survive long enough, you give yourself the opportunity to improve, to learn, to grow. But if you blow your account, that opportunity disappears. Professionals understand this deeply. That's why their first priority is always survival. Everything else comes second. Avoiding all-in thinking. Another dangerous habit is all-in thinking. This is when a trader believes one trade can change everything. They think, this is the one. This trade will make it all back. This is my opportunity. So they risk too much. They go bigger than usual. They put their account in a vulnerable position. But trading doesn't work like that. There is no single trade that guarantees success. There is no shortcut. Consistency over time is what builds results. Professionals avoid this mindset completely. They treat every trade the same, just one of many, not special, not unique, just part of the process.
How professionals recover after losses. Losses are inevitable in trading. No matter how good you become, you will lose. But what separates professionals from beginners is how they respond after a loss. Beginners react emotionally. They feel the need to recover immediately. They rush back into the market. They take low-quality trades. They increase risk, and they often make the situation worse. Professionals take a different approach. After a loss, they slow down. They step back. They review what happened. Was the loss part of the plan, or was it a mistake? If it was part of the plan, they accept it and move on. If it was a mistake, they learn from it, but they don't try to fix it immediately. They don't rush. They don't force trades, because they understand that emotional trading leads to more losses. Instead, they focus on returning to a calm, controlled state. Only then do they continue. The long-term survival strategy. Professional traders think in terms of survival first, profit second. They don't measure success by one trade or one day. They measure it over hundreds of trades, over months, over years. This long-term thinking removes pressure because they know that short-term results don't define them. A losing day is just one data point. A bad week is just part of the process. What matters is consistency over time. This mindset keeps them stable, it prevents emotional swings, and it allows them to stay disciplined even during difficult periods, because they're not trying to win today, they're trying to still be in the game tomorrow. The identity shift, from gambler to professional. At some point, every trader must make a decision. Are they going to trade like a gambler or like a professional? Gamblers chase excitement. They take unnecessary risks. They look for quick wins. They act based on emotion. Professionals do the opposite. They manage risk carefully. They follow rules. They stay disciplined. They focus on long-term results. This is not just a change in strategy, it's a change in identity. It's how you see yourself as a trader, because your actions will always follow your identity. If you think like a gambler, you will take risky trades. If you think like a professional, you will protect your capital. And that shift is what prevents accounts from being destroyed. The power of accepting limits. One of the most powerful things a trader can do is accept their limits. You cannot control the market. You cannot predict every move. You cannot win every trade. And once you accept that, you stop trying to force outcomes. You stop taking unnecessary risks. You stop chasing perfection. Instead, you focus on what you can control, your risk, your behavior, your decisions. This acceptance creates calm, and calm leads to better decisions. The rules that keep you safe. If you want to avoid blowing your account, there are a few simple rules that can protect you. Rules that, if followed consistently, make it very difficult to lose everything. Always risk a small percentage per trade. Always use a stop loss. Never trade without a plan. Stop trading after hitting your daily loss limit. Never increase risk after losses. Never trade emotionally. These rules are simple, but they are not easy, because following them requires discipline, and discipline is what most traders struggle with. But these rules are your safety system.
They are what stand between you and account destruction. The real reason accounts survive. Many people believe successful traders survive because they are smarter or because they have better strategies, but that's not the real reason. The real reason is control. Control over risk, control over emotions, control over behavior. Because without control, even the best strategy will fail. But with control, even a simple strategy can succeed. This is the hidden truth of trading, and once you understand it, everything changes. Final thoughts. Blowing a trading account is not a mystery. It's not bad luck. It's not the market being unfair. It's the result of poor risk management and emotional decisions. But the good news is, that means it's avoidable. If you control your risk, if you follow rules, if you stay disciplined, you can protect your account. And once your account is protected, you give yourself time. Time to improve, time to learn, time to become consistent. Because in trading, success doesn't come from one big win. It comes from staying in the game long enough to let your edge work. And the traders who survive are the ones who eventually succeed.